Hey, it's another great day at the Solomon Trading Institute. Hey, listen, I want to encourage you if you have an opportunity, if you like what you've been hearing so far. Some of you have been following us for a long time. Some of you, this is your first time hearing about us. If you really want to know more about what we do, how we do it, things of that nature, why don't you just book a call? All you have to do is go to www, watch this, moneymarketedge.com, www.moneymarketedge.com, and go to our website. And we'd love to have an opportunity to talk with you and share with you some of the things that we do. Also, it would behoove you to go to amazon.com and pick and check out this book that I wrote, just a little bit about what we do, the money market autopsy, how we kill the market every single day. And at the end of the day, we're just talking about consistency. When we talk about killing the market, we're not talking about making $1 million every day, but what we're talking about is just being consistent. Many people who operate in markets, sometimes they win, sometimes they lose, sometimes they break even. In other words, they're not consistent. They can't put it together over time. And so that's what we are. We're the solution to that in terms of learning how to operate in the markets in a manner that's consistent. Now, I'm sure that there are people who can show you, hey, listen, I made $1 million today and I made 75,000 last week, and all that kind of stuff. But I'm talking about being consistent enough to replace what you do on a daily basis. And that's what we want to be a part of in terms of helping you understand what you need to do. Again, you can go and check out this book and you'll be able to see a little bit more about what we do. Now, here's what I have to make sure that all the parties involved, you, myself, all of our staff, all of our coaches, our teachers, everyone understands, and all of our students, that there are no guarantees. So there's a risk warning. That means that word risk means there's a potential for danger, right? So there's a risk in driving a car. The potential is that you'll have an accident. There's a risk in getting a swimming pool. There's a risk that you will drown if you don't know how to swim. There's a risk in playing football. That means if you don't wear your helmet and your shoulder pads, or you don't tackle properly or learn how to protect yourself when being tackled, there's a risk there. There's a risk almost in everything that you do. But it's important that you understand that there is a risk in what we're doing and that there are no guarantees. What we do guarantee you is that we can teach you how to potentially come to charts every single day and find out what's going on, learn how to apply our trading plan, and get to the point where you can be consistent on a daily basis. And what we call consistency is being able to pick out basically 80 ticks of market movement going in the direction that you want it to go. So I know that we have a dollar sign here, right? And I know this is a dollar amount or figure, but what we teach is it's not really about the money, it's about the skill. Because if you develop this skill, the money will actually come. Actually, you can't stop it from coming if you develop the skill. And so the skill means that we're looking to be able to get at least 80 ticks. All right. So those of you who don't know anything about trading, when the market moves up, they call it a tick. It moved up 1 tick. All right. So that means the market moved 1 price point. So if this price is whatever it may be, X number here, and then if it moves up to this price point, then that means it moved up a tick. It went up a tick. And so what we're saying is that if the market is supposed to be going down, right, and you enter here, it should be moving down this way. You should be gaining ticks that way. All right. If the market should be going up, that means you enter here and it'll go up. Let's say it go up ticks. What we're saying is that whether the market's going up or down, that you can earn 80 ticks. The potential is there to get 80 ticks out of the market every day. And if you do that, then the money automatically will do what the money will automatically follow you. So that's what we, want you to have a great understanding of, and that we can help you, with that. So it's important that you understand that it's critical that you understand that this is possible for you, just like it has been possible for so many of the people who are, a part of what we do. That's a part of our milieu. So look forward to having an opportunity to speak with you, and perhaps you can, do what so many others have been able to do, and that is understand our trading plan, get to know it, learn it, get to the point where you can execute. And we're talking about 80 ticks. Now, sometimes that even takes place in one particular trade. In this particular trade, and I'll talk more about this trade as we go in the market recap, but in this particular trade, I'm already up 60 ticks in this one trade, and 80 ticks is the goal. So I think, it's important to understand that this is something that's doable. Now, on today, if you notice, this is, and let me just make sense of these numbers for you. So we focus on trading. We focus on the skill, not the money. We focus on the skill of trading. And so once you understand the skill of trading, then guess what? The money automatically would then, just kind of show up potentially, right? And I have to use that word potential there. So here is the number of ticks. So when we talk about cumulative net profit here, we're not talking about money per se, but we're talking about the ticks, because if you get the ticks equal the money. So in the NQ, and this is different for other markets, but in the NQ, watch this, one tick equals $5. All right, per contract. So if you take 143 and you do what? Multiply that by $5, you will see how much money it is per contract. And the goal again is only 80 ticks. Here on today, that's 143 ticks. Now, there are many of you who will do like I do, which is just trade the first hour, maybe hour and a half, which is from 8:30 to 9:30, 9:45, 10 o'clock-ish, somewhere in there. But there may be a couple of you that say, hey, look, this is kind of what I want to do. I'm at the age and stage in life that this is what I want to do, all day. And so what I want to do is kind of give you an idea if that's your style. And there's nothing wrong with that, just, kind of idea of what that looks like if you were to do that. So here's what I did. So I traded from 8 o'clock to 2 o'clock. So that's 1 hour, 2, 3, 4, 5, 6, 7. So that's how cumulatively we ended up with 145 ticks. Why? Because we stayed the whole time. Now, so in the 8 o'clock hour, which really this was only 30 minutes to be fair, because 8:30 is when the market opens Chicago Central Standard Time. And so here got 30 minutes was in the green. The second hour, 4 hour in the green. At 10 o'clock, we hit some red. 11 o'clock back in the green. Lunchtime, we hit some red. 1 o'clock after lunch in the green, 2 o'clock in the green. So now the more you expose yourself, of course, the more opportunities it is that you have to deal with sometimes some drawdown. So if you see 8:30 to 10 o'clock, which is normally the time, there's no red there. And sometimes there is red. But my point to you is that if you do want to trade all day. Somebody said, well, I'll do that all day because that's what I want to do. And if that is the case, then guess what? You can do just that. So as we look at this and just kind of see this and just kind of go over the recap again. So in this one day, there were 145 ticks. Now, it's possible that you can make more money in bed than a lot of people make on their feet all day. That potential is absolutely there beyond a shadow of a doubt. So today, all day in bed, it's, the holidays and traveled and nothing really to do. Nobody's really doing anything. So I just kind of did this, just at my leisure. And this is something that, that you can do as well. So let's kind of look at, now, how does this happen? It does not happen by osmosis, it happens by a plan. The first thing we have to do is we have to forecast. We have to know where price should and should not go. And so identifying the moves, identifying the day type, is the market going to go up or down today? Identify major structures, what could stop or hinder or halt my trades. Where are my high volume areas that I need to be aware of when I get to, so that I can wait and see what the decision is going to be. And then my top-down analysis for momentum confirmation. All of this information, except the news announcements, we get the news announcements from third party, but everything else that you see that you would need to know can be found on this chart. This chart lets me know everything that I just said to you. This chart lets me know everything, again, that I just mentioned. So in forecasting, this is where we get that from, okay? Our high volume areas, this is where we get that. Our major structures, this is where we get that. The confirmation of long-term momentum, this is where we get this from, just from this chart. This chart is talking with us. This chart is having a complete conversation with us. The red, the green, everything, the boxes, everything, okay? All right, so the next phase is what? Recognition. We have to recognize the probability, recognize the market structure, and recognize, do we have momentum in the direction that we want to go to? Where do I get all of this information from? Not the television, anywhere. I get that from this chart. This chart is telling me my probability. This chart is telling me my momentum. This chart is telling me my market structure. Just this one chart, okay? Well, how do we make those ticks? The next thing is that we have to have an entry, right? We just can't jump in the market. We can't kick this door down, beat this door down, bash the door down. No. We have to wait until it opens and then simply do what? Walk in it. This is the chart that we're looking at that tells us how to enter. This is part of your sophomore curriculum, where you will learn the names of the trade setups. So this is the entry chart. So we have forecasting. Look at the names of this: layup, impulse with the target in sight, layup, final test, layup, entry, got stopped out on this one, re-entry right here, layup, channel 3D, final test. You see that? So when we're in the education room and I simply say, okay, based on this this particular market condition, there's a layup setting up. And as a subscriber, this is a part of our plan. Make sure you protect yourself at all times, like in boxing with your stop loss. Everybody, some people risk 3% per trade. Some people risk 1% per trade. Some people 2% per trade. That is individual financial advice that we do not give. But what we're talking about is the strategy in and of itself. And so we talk about the trade setups. So it's not, look who's here, Punchinella, and just get in and just try to hope that, the rope doesn't hit you in the face, but no. So what we do is really organized and, and strategic, if you will. So this is, the thing that we kind of look at as well. Now, here is another place. Okay, so look at this. So in this area, this is a high volume area. It's a high volume of what? Sellers. So look what happens when the price hits this area, right? When the price hits this area, look at what happens. Here, we were taking long trades all the way up to this area. Boom. Once we hit this area, it's a high volume area. So now we know that the market is going short and we start taking shorts. When we hit this edge, we know now that the market is going back long. And then now we can start taking, listen, the entry, the forecasting, the direct, all of that stuff is something that you won't be guessing about. It's something that you will know is about to happen. All right. So here is an example here that, okay, the market now is moving up, right? So now it's moving up. So what do we know? We know that we can enter here. We know that we have room and space to get here, okay? So at this particular time, boom, we entered here. We took our trade off here because we hit here, and I'll talk about this in just a minute. We took our trade off here, but we're talking about the entry. Well, guess what? Once we hit this area, this high volume area, now we start taking trades short. going in this direction. And you see here before, you know, as I was taking this picture, the market had moved down. All right. So this is what we're talking about, the interest. Everything will make sense. All right. And so again, this is what you will learn. Now you will learn this again. This is a part of your Southwell curriculum. Every trade has a name. Every setup has a name, right? If it doesn't have a name, you should not be doing it because it's not a part of the strategy. Okay. So now after we forecast, after we recognize, after we enter, then the next thing that we have to do is do what? We have to manage. Once we enter into the trade, we have to manage our positions. What management style are you using? It depends on what the market is doing. There are sometimes the market will give you an opportunity for single targets, multiple targets, right? And sometimes the opportunity will give you the opportunity to trail to loosely or tightly because the market does not have any major structures that should hinder it, right? The true average range may get you because the market, each leg does have a range, right? It's called the ATR. But when you don't have anything in front of you, now you can trail, right? So the different management styles, okay? So look at this management style. So this management style is what? Is we are trailing because the target is all the way down here. And this is the trade that we're up 60 ticks on. There are some trades that go 120 ticks, 130, 140, 200 ticks, right? So, but we're in this particular style. Why? Because of what? There's air, there's open air, there's space down in here. So in this case, our management style would be what? To trail the position. Does that make any sense? So, and sometimes our management style is to hit a target because the target is close, all right? And so we'll talk about that when we move to exits. So after we forecast and after we recognize and after we enter and after we manage, then we have to exit. In this case, our exit is a trail out. You see, this is where this particular move got started. If you can really look at it and see it, this move got started up here, right? Up here somewhere. Now, so as the market started going down, I started trailing it. So here is my stop loss. My stop loss, we're locked into profit right here. We're locked into profit right here. In other words, this is a risk-free trade because this is my entry. And as the market moved down, right, we started locking in, right? So this is what we call a yellow rope trail. You see that yellow rope? And I'm trailing that rope. But because I got to this low right here, I decided to press right in here because I didn't want to risk the opportunity of the trade coming back this way. And ultimately it worked all the way down here. But I wanted to lock in this. Remember, our goal is just 80 ticks. I'm already up 60 ticks. Heck, I mean, let's get paid. You understand what I'm saying? You know, so you know, I don't mind trading often, trading small and trading often, trading small and trading often versus allowing the market to whipsaw and come back and I get nothing out of it, right? So as that market moves into profit, in this particular instance, we just press down a little bit there. So I think that's really key for you to understand, you know, as you're learning, because I'm not the only person in America that knows this. So you may not decide to join us. You may decide to join someone else, but something that I'm saying may be able to help you, or you may be a current trader and I've given you enough information to help you now. So that's fine as well. So because that's what we want to do. We want to seek to be a help. Okay, so how do we exit? So we find, how do we exit? Well, we exit based on what the chart is telling us. So sometimes, and I want to give you an example of a target. So I just showed you the management style where we were trailing out, right? Pressing out is something else. That's when the market is reaching a place that may turn it around, a high volume area, and you would just simply move your stop loss up so that if it does come back, you would be automatically out of the trade. So let's kind of look at what this one does. So here is a trade, all right? And This is what we call the edge. So this is how we read our rhythm. So you see how the market has a rhythm to it. It goes to this extreme edge, comes back to imbalance edge, goes up to extreme edge, come back to imbalance edge. So this is our rhythm reading, because if the market should be moving up, then this area should open up for us. So now here is one of our trade setups that we call the bounce. We noticed that the market gave us a lower high. So look at what the market was doing. The market was making higher highs, and I'll show it to you. So the market was making a high, and then it made a higher high. Well, right here, it made a lower high. Once the market makes a lower high, what we do is we mark that area. And what we call this is our prime liquidity location. So what we're waiting for is we're waiting to see one of three things happen. Because at all of these lines here, at these liquidity lines, one of three things may happen. And I'm going to use this as a liquidity line here, okay? The first thing could happen is that the market could break it, retest, and bounce. That's why we get the name bounce, because the market broke this area, retested, and bounced right off of this area. You see that? And so this is a trade that we entered. Now, here is where we entered this trade. Now, look, this was the target, because now we're moving into this area where there's a high volume of sellers present. You see how this is not luck? We're not hoping, oh, we hope the market goes up. We hope. No, 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 no. We know, because what we did was we identified the institutional involvement, because when we are in a trend that's moving up, as you can see, there's a slope in this rope here. So there's a slope in the edge. There's a slope in the extreme edge. We know that there's volume here. There's value going up this way. So because we know that, now we're looking for our entry. So we've done our homework before we get to this point, our forecasting, our recognition, and we find now our entry. Our entry here is a bounce. Why do we call it a bounce? Because the market went up above the liquidity line, retested the liquidity line, and bounced off of that liquidity line. And once we get that to happen, then that's where we look to make our entry. You see that? So the market, what did it do? It went above this liquidity line, pulled back, and it bounced. That's the entry. We entered right in here on this signal bar here. And guess what? We got up into this area. And what I did was I pressed out. So we took the stop loss, and this yellow rope right here is where we say, hey, listen, we're going to give it an opportunity to go, because the point of control is a little bit higher. So we're going to give it an opportunity to go. But if it comes back here and stops us out, we'll get out right here. And that's $90 per contract if you're trading 10 contracts, which is what we, our ultimate goal is that, well, you can count. Now that word potential is there because the government makes sure that we listen. There are no guarantees. You can lose your hat, you can lose your coat, you can lose your shirt, you can lose your underwear, you can lose your shoes, your socks, you can lose your toenails. You can lose money in the market, period. So there's no guarantees. However, what we're showing you is that we, from an educational standpoint, from a technical analysis standpoint, from a volume profile standpoint, from high volume area standpoint, understanding where the high volume areas are, how markets work from distribution to accumulation to distribution to accumulation. We're going to teach you how the markets work, and then you can make educated decisions and put what we call probability on your side. So you see how simple that was. We identified the extreme edge. And we identified the liquidity location. We waited to see what the market did. Once it did that, and then what do? We took advantage of it. And this is so simple. I want you to see this work. I want you to see this work. I want you to see this work yourself. Now, watch this, kind of work yourself. You don't have to, wonder how it happens. Look, so what do we need to identify? I just showed you. We need to identify, there it is. Let's identify the liquidity line, the prime liquidity line. You can see there that there was a what? There was a low that was made. There was a lower low that was made right in the midst of what was going on right here. And so because this lower low was made right here, then what we see, hey, we have to draw what our liquidity line right in there because of what we just saw. All right, so that's the lower low that we see right there, and we drew the liquidity line right there so that we can see it happen. All right, so watch what happens now. We're waiting for the price to go across this liquidity line, right? So we have a statistical advantage, if you will, to understand the the volume profile and everything like that. But it's just simply following the rules. The rules of the bounce entry is to make sure that you see the market make what? A lower low, a lower high. In this case, it made a lower high again. So what do? We adjusted the line. Now look, we're going across. That's the break. Now we're waiting for the retest. We have our hand on the buy button, in. All right, right there, 10 contracts, we're in, and now we're waiting. We already know, bam, we go straight through the target. That one trade with 10 contracts is $1,455. You see that? Just that one trade. So what we seek to communicate to you is that this is not rocket science. You did not learn this in school, right? So what's your story? Are you ready to change your life? It's not your fault that you didn't learn this in school. Many people in their economics class, they didn't learn that. They didn't understand markets and how they work. Again, I would love to, speak with you, talk with you. You can join the chorus of people. We have students from Africa, Canada, and all of these states. We'd love for you to be a part of, what we're doing. Simply go to www.moneymarketedge.com, book a call, let's talk. And see whether or not we're a good fit. We would be a good fit for one another. If you want more information, you can text the word profits to 94253. I would love to have an opportunity to chat with you, and we can see whether or not we'd be a good fit. Hey, listen, if you would like for me to come to your church, your school, all over the country, I do this at churches, auditoriums, seminars, workshops, things of that nature. Would love to come. Call our general manager, and he will make sure that everything is copacetic in order to get that done. Well, again, I'm Cornelius Wilson Brown III. It's the will of God that you prosper. Have a wonderful, wonderful day.